Hey Lisa, I wanted to make a video for you. First of all, to put my new GoPro to good use, and second of all, to kind of explain that hedge strategy we talked about over the weekend. So, just really quickly, um, basically the idea behind it is that a market, even though our stock market has an upward bias, obviously if you bought and held, in 1900, you would have had great returns by now. But that doesn't really move up in a straight line. And obviously the problem with buying and holding, whether it's using leverage or just straight out buying an index tracking ETF, if you're unfortunate enough to buy, say, right before the Great Recession, the financial crisis, then you're pretty much in the hole for, I think, what was it, 4 or 5 years before you even got back to break even. So uh, what I try to do here is to take advantage of ripples in the market, because the market doesn't just move straight up. The market's not completely efficient. If it were, the market would open at one price every day and it would stay there, and that's the price. But in reality, financial markets are very very much an emotional driven thing. So what this system does is it tries to define areas in the market where uh, emotion is kind of at a climax, and then set up to catch the wave going in the other direction. So if you have too many sellers in a market, and the market's coming down and everybody's selling, 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 especially the people that are selling short. I mean, once you sell short a financial asset, what do you become? You become a buyer. So on the way down in a market, for example, there's all those sellers in, and they become buyers. So once that selling is over, all of those people that sold short are going to need to cover those shorts, and that's going to drive a upward price ripple. So what my strategy does very basically is use precision to try and pinpoint those areas in the market, and kind of like a surfer, get on board and try and get in front of that wave. So uh, enough talking. I'll show you some of the actual results here. Uh, Basically, the Nasdaq is up 6% year to date if you bought it without leverage. The kind of leverage that I use in my back testing is maybe about 4x leverage, 3 times. But I think I'm going to show you a buy and hold. If you bought at the beginning of this year, I think you'd be up something like 20 something percent using that amount of leverage, versus with this strategy the return is like 550% or somewhere along those lines. Anyway, I'll show you right now. Okay, so what we're looking at here is a basic stock chart of the Nasdaq Composite year to date. So drag my mouse. So this should be January 1st. Well, it's January 2nd. That was the first day the market was open this year, and this should be Christmas Eve. So this is the market year to date. I'm going to apply a strategy to it that just would have bought it and held it at the beginning of the year. Buy and hold. Okay. Okay, so the buy and hold strategy, this green line here shows the cumulative return you would have had. So and this is over here, you start at 0 because this is the first trading day of the year. So the buy and hold strategy would have returned that kind of in a choppy sort of manner down here about at this point 22 $25,000 off about a $10,000 investment, which is obviously really good. That's just buying and holding and using a lot of leverage. And so leverage obviously means if the Nasdaq is up a percent with leverage, you multiply that by whatever kind of leverage you're using. So there's the buy and hold for year to date. Start at 0. End of the year would have been 23,500. So now I'm going to apply this hedging strategy that I talked about, which I coded into the computer so the computer could back test it over time, and I'd be able to get real-time results. So real quick, this is a pretty simple strategy in practice. This is the code I wrote for it. As you can see, it's not too many lines of code. I think it's about 60 lines of code, so nothing too crazy. So let's go ahead and apply that. Okay, so now you can see the strategy is applied, and here's your 0. Start at 0 at the beginning of the year, and then by the end of the year today, it's up about 55,000. So more than 2 times what you would have gotten out of buy and hold. And also the the equity line is a lot more gradual. It just you just see it kind of compounding, which I think is a lot easier to sit through. I'm going to zoom in here really quickly and sort of show you what I mean by catching sort of these waves in upward movement. So here, if you can see it, is when the market kind of broke down pretty heavily in August. So here the market came down about this almost a 500-point drop in a couple days. And right here, right around here is when I would have gotten the go-ahead, sort of green light, if you will, to get in, and then I would have been able to get out right there. And that's just one of these market waves that build up from an over exhausted amount of emotion. And it's all this panic, sell, and that all builds up. And especially the guys that are trying to sell the market down here, when it doesn't go down, it starts going up, they just get run over. And that's what really drives this price up, is when all those guys need to cover their shorts and just buy at any price. So this wave just kind of comes and runs them over. Okay, so now we'll go back about 4 years, buy and hold. Okay. Okay, so here's what your result would have been had you just bought the Nasdaq Composite at the beginning of 2012 here, yeah, and held it all the way through here. So it's a very nice return. These last 4 years were probably some of the best for the stock market in history. So it's no surprise you would have started at 0 and ended up at about 139,000 with all this leverage, which is a really big return. But I mean, even in a market environment that is going nothing but up, ideally I should still be able to beat it. So I'm going to add the strategy in here, apply it, and there you go. So instead of 139, this returned about 170. So even in an environment where the market's going nothing but up, this kind of active trading style is able to beat that market by a sort of simple but effective hedging strategy. So there's some of the numbers on that for you. Okay, last thing I want to talk about real quick was brokerages. I've done some research on a lot of them, and ideally, what would work best is whatever is a reliable broker, obviously, and with the lowest commissions possible. So I really like the Robinhood one. I looked into it. They're FDIC insured up to like 500,000 or something, and apparently a really good broker, and the commissions are free. So I think that's probably the way to go as far as a broker, but definitely do some more research on that. Alright, well cool. Just wanted to make this quick video. Again, just to test out the GoPro, and then also to send you that information. Alright, Lisa. Bye.